We're going to get started here. I'd like to welcome you all today and thank you for joining us in the midday webinar. This webinar is hosted today in conjunction with OptionCity and the CBOE Futures Exchange, also known as the CFE. My name is Jim Abbott. I'm with OptionCity, and along with me today is Jennifer Fortino representing the CFE, and we're delighted to host Russell Rhoads, a new author of a book, Trading VIX Derivatives. Russell is with the CBOE Institute. He's an instructor there. This is his third book. He's an expert on trading VIX futures and future spreads, and this is part 2 of our three-part series hosted in conjunction with the CBOE Futures Exchange and OptionCity. At this point, I'm going to turn it over to Russell. He's going to give us a brief description of his book and how to trade the VIX futures, and a little background on how we outlined in the first webinar of the basic building blocks of defining the VIX, defining the different specifications of the contracts. And now we're going to go a little more in depth. This webinar is not going to be a sales pitch. It's purely educational, and we hope you get something to take away from today. So at this point, I'm delighted to hand it over to Russell Rhoads.
All right, thanks a lot, Jim. As Jim said, my name is Russell Rhoads. I just wrote a book on the book's been out a couple of months now, Trading VIX Derivatives. In addition to talking about VIX futures and options, I talk about the ETNs as well in the book. Part of what I'm going to talk about today is included in the book. Put my disclaimer up here for just a second. As Jim said, we're not selling anything today. I'm here for educational purposes only, and that's kind of a good summary of what is sitting in front of you right now. I've got a couple of trading examples that exclude transaction costs. That's just for simplicity's sake. And again, anything that I show today, I'm using actual VIX futures contracts or historical VIX futures contracts. Again, I'm just educational purposes only. Don't take anything that I'm saying as a recommendation. As far as the outline today, I'm going to start out talking about the VIX. This is definitely kind of closer to an intermediate than a beginner discussion today. But because the VIX is still a little bit misunderstood by a lot of people and a relatively new product, I like to start out at the very beginning, make sure everybody's on the same page before we start talking about trading strategies. And then we're going to get into futures trading. What do you need to know before you actually decide to do a futures trade? And then I'm going to a study I did recently where I took a look at some of the recent spikes, and not the recent spike from yesterday, but recent spikes in the VIX, and just took a look, compared different VIX trading instruments as far as what would have been the best way to go about taking the other side of a big move to the upside in the VIX. Also, going to talk about, then we're going to move on to calendar spreads. Start by showing what I refer to as the term structure of VIX futures. You can chart out the 8 or 9 months of VIX futures that are listed against the VIX index and get a chart that looks like a term structure. And then also, we're going to finish up and talk about calendar spreads and use a calendar spread example from a little while back, but a pretty appropriate calendar spread based on a normal VIX curve. And then we'll finish up, and I'll do my best to take as many questions as possible within an hour or so. I believe that's how much time we've got for today. Starting out with just what the VIX is. The VIX, the official name, is the CBOE Volatility Index. You might be watching CNBC or one of the business networks at some time, and they'll be citing the level of the VIX relative to what's going on in the overall market. Yesterday was probably one of those days where where you would hear what the VIX was doing when it was up 30+% with the market under pressure like it was. Sometimes they don't give it the right name. Sometimes they call it the S&P 500 VIX or some other derivation of its official name. But the official name is the CBOE Volatility Index. The VIX is based on, basically it's a measure of implied volatility in the S&P 500 SPX option pit at the CBOE. We usually we use the next 2 expirations that at least have a week or so to expiration. So right now, I believe we're pretty close to switching from November and December option contracts to December and January option contracts. We take all the at-the-money and out-of-the-money options that are basically liquid, that have a bid and an offer in that arena, and take the midpoint of those option contracts and come up with a synthetic at-the-money 30-day option contract that expires 30 days from this very second. The implied volatility of that synthetic option is what you see quoted as the VIX. You don't have to remember all that. All you really need to know is it is 30-day implied volatility as indicated by S&P 500 index options. And as I mentioned the business networks a second ago, it has been promoted as the fear index by the business media. There's that inverse relationship between the stock market, or the S&P 500, and the VIX, and that's why we tend to get a lot of attention out of the business networks on down days like yesterday. VIX Futures, the products that we're talking about today, take $1,000, you multiply it times the level of the VIX index, or the quoted VIX future contract, and you get the full value of the contract. When I left the CBOE and walked over to OptionsCity this morning, the November VIX was trading around 34 or 35. Let's call it 35, so that's a $35,000 value for the November VIX contract. We list up to 9 months of expiration. I've seen 9 months every once in a while. Usually it's the next 8 months. One of the things to always be aware of if you're trading VIX futures or VIX options is they expire on a Wednesday 30 days before the S&P 500 standard expiration the following month. Standard expiration is the third Friday of each month. Take the third Friday in December, subtract 30 days, and you would get the corresponding November VIX expiration for both the futures and the options. And I like this last bullet point. Unique characteristics, I consider that kind of an understatement. That as far as they're completely unique relative to other financial futures contracts. And I think that uniqueness allows, it creates interesting opportunities for institutions and individuals. That unique feature is basically that the pricing, for lack of a better term, is anticipatory. There's no real fair value. And when you, again, use the business networks as an example here, if you got up this morning like I did, turned the TV on around 5:30 or 6 Central, and took a look at what the market was indicating as far as an open for the S&P 500, you were taking a look at the S&P 500 futures. And there's a fair value between the S&P 500 futures and the S&P 500 index. There's an arbitrage opportunity that professional traders can buy a basket of stocks and short the futures, or vice versa. So the S&P 500 futures stay within a range around the S&P 500. The VIX futures are anticipatory, and at times they're at a discount, and at times they are at a premium to the VIX index. More often than not, the futures have been at a premium than a discount, but the VIX futures and the level of the VIX future contract is based more on a market outlook than some sort of arbitrage, and that's really what differentiates VIX futures and the VIX options relative to other financial futures or index-related option contracts. Now, just to get an idea of, not making, well, I guess I am kind of making an argument for the VIX futures to be the best method to replicate an investment in the VIX. Took a handful of instruments. Gold and GBZ are on here because they are the kind of products that get attention during the price of gold. Tends to rise when we're in times of uncertainty, much like implied volatility of the stock market. So those two instruments are on there as well. But really what I'm trying to show here is the VIX futures market relative to the VIX index, and some other instruments that you might consider buying if you're worried about increase in market volatility. Interesting part here is the VIX future, and that's the front month VIX future, is probably the closest in performance to the overall VIX index over the first 10 months of this year. That's basically through the end of October. The VIX future was up. If you've been able to maintain a front month position in the VIX future, you'd be up around 34%. The VIX index is up around 40%. And you can see the other instruments, there's some definite disconnects in there. So the VIX future probably is the best way, and by association VIX options probably the best way to try to replicate the performance of the overall VIX. Now, when you're thinking about trading VIX futures, you definitely want to have some sort of outlook for volatility in the overall stock market. You want to have some sort of awareness of where the futures are priced relative to the index. If the VIX is at 40, and let's say you think that volatility is going to come in 10 points or so over the next month, and the corresponding VIX future contract that you wanted to trade is already at a 10-point discount, you might want to reconsider using the futures contract as a trade in that case. You definitely want to have some sort of overall outlook for the stock market. The inverse, there's an inverse relationship between the S&P 500 and the VIX index. About 75% of days when the market trades up, when the S&P 500 trades up, the VIX will move down, and vice versa. About 75% of days when the S&P 500 moves lower, the VIX will trade higher. There's definitely an inverse relationship there. So you want to have an idea of what you think is going to happen with the stock market as well. And then with any derivative contract that has some sort of expiration date, you definitely want to have a time frame in mind related to your trade, because you want that time frame to fall within the expiration date. And what I'm going to look at as far as VIX futures, I'm going to take a look at, I'm calling them short opportunities, but we're going to take a look at a handful of times over the past couple of years where the VIX index has spiked up, and some of the different methods that you might consider if you wanted to take the other side of that spike, if you wanted to short volatility or get short exposure to the VIX, based on an opinion that would ever move higher. This is totally based on, hindsight's 20/20. It's totally based on us having a correct opinion when we had a spike in volatility, that volatility was going to come in over the next 5 days or so. When the VIX rallies, the futures tend to follow to the upside, but very often we don't see the futures rally up nearly as much as the index. I believe this was an indication yesterday where the front month VIX rallied up an awful lot, or the VIX index rallied up a lot, and the November futures didn't quite rally up nearly as much. I know December didn't follow, and the farther out we went, the less of a rally we had yesterday with the market selling off like it did. One of the results when we see the VIX spike up and the futures not trade up as much is a reluctance to consider taking a short position in the VIX futures. You might look elsewhere for some sort of trade to do if you believe that the VIX is overdone and going to come in. So I took a look at, again, the VIX futures, shorting the VIX futures, and a couple of other methods of shorting, getting short exposure to the VIX, and the results were kind of interesting. The method here, we started with a big move in the VIX index to the upside, and then took a position in a product, and you can see I'm not saying a short position because there are a couple of things that we would consider buying in this case, and then just held the position from close to close for 5 days to take a look at what would have worked out as far as getting short exposure to volatility. And here's, Jim mentioned I've written 3 books. My first one was on candlestick charting, so any opportunity to throw a candlestick chart into a presentation, I take full advantage of.
Who doesn't love a good candlestick chart?
Who doesn't love a good candlestick chart? So, if anything, they're good for your kids to color in. So what we've got here, for those of you, I think just about every market participant can take a look at this and remember what we're looking at here. This is when the market sold off on August 8th, just a couple of months ago, just over a couple of months ago. Market sold off, and that's where the VIX went from a close of 32 the day before to a close of 48 the day after, or just a close of it was from 32 to 48. Nice round numbers, too. It's almost like I've made them up for a textbook, but that's what the numbers were. So the idea here is on 8/8, on the close, we see this big spike, and we decide to take the other side of it. And, of course, we're going to be correct because we can see 5 days later the VIX is lower. Now, the methods that you may have considered in this case, the VIX was up to 48 within 5 trading days on August 15th. It was back down to 31.87. It actually did a complete round trip over 5 days. And this was the first This instance in the marketplace is the one that really got me looking at what the best methodology to take the other side of this move in early August was. VXQ11, that's the August contract. It was still active at that time and hadn't expired at that time. Notice that on August 8th, the August VIX future only traded up to 36.55. It was still at a discount. So the VIX index traded up to 48, and you're like, hey, I'm going to short the VIX. You see that the August VIX futures at 36.55, and you might be a little reluctant seeing that disconnect between the two prices. But you can see that future contract traded off. It traded off around 12%, not quite the 33% that you would have gotten if you'd been able to short the VIX index, but it was also the best method to take the other side of the VIX in this case. VXU is the September contract. You got about a little under 12% out of that one. The VXX is the most actively traded ETN based on the VIX, and it traded down by about 7.5%. That the VXX gives you exposure to the front 2 months futures. So it's actually an ETN that's giving you exposure to that August and that September contract. VXZ gives you exposure to farther out implied volatility. I believe the 4th through 7th month on the VIX curve. Shorting that, you'd have made about 6% or so. The XXV and the XIV are actually inverse ETNs relative to the VIX, and that's why there's a little star there. You actually would have taken long positions in those two, and really wouldn't have done particularly well taking long positions in either of those two instruments based on your opinion that volatility was going to come in. So in this case, in this first case here, the near-month VIX future was actually the best contract. The front month VIX future was actually the best contract or the best method of taking the other side of that spike. And I'd actually, this came from a question from an individual that had seen one of my VIX presentations, asking for a hindsight answer. What would you have done? Oh, I love the hindsight answers instead of what should I do, because I'm allowed to answer those. And that's what led to this study. And then I said, self, why don't we look at a couple of the other spikes that we've had over the past couple of years? And the results were kind of interesting as well. Back in March of this year, same sort of situation. Got a big move in the VIX index, March 16th of 2011. And again, we're going to take the other side and hold it for 5 days. Same methodology. And the VXX did okay relative to the front month future. Because it was March 16th, toward the end of March, the front month future was April. Could have shorted the April contract, and again, notice the difference between the closing price on 3/16 in the VIX index and the closing price of that futures contract. It's a 5-point discount. So again, I think that seeing that discount, I think, causes at minimum some traders to take a pause when they're thinking about shorting the front month future like that. But again, that was in this case, it was actually one of the better ways to take the other side of the VIX. The best method in this case was actually the XIV, which is, again, one of those inverse ETNs. If you had purchased that one, you'd have been up about 20%, and the VXX did just a little bit better. The second month future, I guess, came in 4th place here with a 14% gain if you had taken the other side of it. And VXZ, since it's a little bit farther out and you get a little bit less of a move farther out on the curve, it was only made about 11% or so. That XXV consistently seems to not do particularly well, and it's supposed to be an inverse ETN based on the VIX. So, and then finally, took a look at another spike, but for fairness' sake, we actually have to say there's 2 spikes on here. One on May 7th of 2010, which came shortly after May 6th, which is can't believe it. Nobody's written books about May 6th yet, but that was the flash crash about a year and a half ago now. And then we had another, reached another high. We dipped, hit a low around 5 days in, and then had another opportunity. I guess the VIX gave us 2 opportunities here. And in this case, we don't have the inverse ETNs back in 2010, so we've only got a couple of comparisons. But the VIX was down around 23%. Again, the front month future, as far as the futures go, was probably the best way to take the other side of this. Not nearly the performance you would have gotten out of shorting the VIX, but the front month future was a pretty good way to go there. And then the same thing on the 20th. VIX was up around 45. You've almost got the front month future, which is now the June contract. The May contract had expired at that point, and the June contract would have given you a nice 17% return if you, again, taken a short position and just held it from close to close for 5 days. The VXX did fairly well, but and the VXZ, again, you look farther out on the curve, you get some performance there, probably less risk with that performance, but not quite what you would have gotten out of the front month futures. Basically, and this is to be expected, since the VIX index will spike up more than the performance that you'll get out of the futures or the ETNs that have their value based on positions in the futures. When you get a reversion to the mean or you get a drop in volatility, and then that's reflected in the VIX index, you're going to see a bigger drop in the VIX index than you're going to see in the derivatives that trade on the VIX index. Just going through these 4 cases, and I'm sure there are a lot more cases out there, I'm probably going to try to quantify it a little bit more and maybe say what's the best method if you have a 10% gain in the VIX or something to that extent. But at least in these pretty extreme cases here, the front month futures were probably the most consistent method of taking the other side of any sort of spike in the VIX. So that's just one methodology of using VIX futures, and just wanted to show how the VIX futures do have a pricing disconnect relative to the index, especially when we get really large moves. And I had no idea that we would have a large move the day before I came over to OptionsCity and spoke, but I guess it's kind of timely as well. I'm going to talk about the term structure of VIX futures and how this relates to possibly doing a calendar spread with the VIX futures. This modified, which says mod VIX future on here, that's actually a weighted average of the front 2 months futures contract. And you can see the majority of trading days, even in 2008, the majority of trading days, the average between the first and second month VIX future is at a premium relative to the VIX index. So that would indicate that when we see something like that, we're in what we would refer to as kind of a normal market environment. It's more often than not, we have the VIX futures as the farther we go out, trading at a premium to the index. I say that, and that's not the case at this moment. And you can see we've actually had fewer days because we've had some interesting volatility this year in 2011. The numbers for 2011 are through the end of October again, but it seems to be a correlation between the performance in the overall stock market and how often the futures are at a premium relative to the VIX index. You can see that definitely when you take a look at 2008. This is a nice, clean textbook version of the VIX index relative to the VIX futures contracts. And the closer we get to expiration, or the closer, or the less time that's left for the life of a VIX futures contract, the closer it tends to be to the index. The farther out we go, there seems to be a smoothing of the curve the farther out we go, less difference between the prices of the various futures contracts. Now, just it is a methodology here. You could take a look. Let's say you expect this curve to hold up in shape. Nothing's going to, the price can go, the VIX index price can go from 20 to 25, but you expect this shape to hold in place. You could actually consider selling the 4th month and buying the 5th month, and then as these futures contracts move along the, that's why we had 2 slides in.
That's right.
So, but this is actually what, I'm going to try to hold it here. So, well, actually what you can see there, I'm going to go back to. It doesn't want me to go back to. So, well, what we actually had there was we had covering a short at a discount to the long contract. However, and people, and often a question is, well, why don't we consider, just shorting the futures, shorting the contracts that's going to become the front month? Well, this is what could actually go wrong. If you get a spike in volatility, this is kind of what the curve looked like this morning. If you get a spike in volatility, the front month is going to move up tremendously, and you would get caught short that contract. You would get somewhat of a cushion if you had taken a long position in the next expiring month. And basically, what you're trying to do is you're trying to take advantage of that term structure by having a long position in the farther out month and a short position in the near month. And I'm going to give an example of this from about a year ago, where we had a fairly normal-looking curve in September of last year, and we'll take a look at what happened over the course of about 10 weeks or so between early September and close to November expiration. This is back from September 9th of 2010. This is what the actual curve looked like, and we had the November and the December contracts at pretty similar pricing, with the VIX index at a discount to both of those contracts. So, putting on a calendar spread, we would consider selling the November contract and taking a long position in the December contract. And do what? And the expectation here was the VIX index to basically be steady into November. The result, we need to have a target for both of these. So the result would have been the November VIX at around 2280 at expiration. When we do get close to expiration, the futures contract will trade at a pretty close price to the index over the last couple of days. And since when I took a look at this and paper traded this, I actually went through the whole process starting in early September and monitored the progress of this trade. Just to have an outlook for the December contract, at that time, the September contract was at about a 3-point discount to the October contract, so I just kind of kept the same. My outlook was based on the curve maintaining kind of that consistency. And based on that forecast, looking out to just before November expiration, taking a short position in the November contract, making a little over 6 points off of that short position, and then giving up a little bit of performance, a little over 3 points, by having a long position in the December contract. And keep in mind, we want some protection against some sort of inverted curve or some sort of spike in volatility. And very often we see investors seem to, I think it's just ingrained in some of us, especially those of us that have been around for 20 years or so, that if something bad is going to happen in the market, it always seems to happen in the fall. So we always worried about, October for those of us that were around this long ago, October of '87, kind of sticks in our mind as well. And I guess for newer market participants, October, November of 2008 sticks in there. So taking a short position in the November VIX future, you definitely, if you have that mentality, for some of us that have been around for a while, you definitely want to be hedged in one way or another. And since we're talking about calendar spreads with the VIX futures, buying the next month out is one of the ways to go about being hedged. Now, fast forwarding here to not going to take you through all 10 weeks of the trade, but fast forwarding to the Monday before November VIX expiration, on the close we actually had the November VIX at a slight discount to the index and at a discount to the December VIX future, which is exactly where we wanted things. The outcome, when you got so many moving parts, the outcome cannot be exactly what you were expecting, but made a little over 9 points off of that short position in the November contract, gave up a little over 7 points in the long position in the December contract, but I think we rested a little bit easier at night, didn't worry about a 400-point down day in the Dow the next day with our short VIX future position. And the result was a profit of just under 2 points or so. And again, taking a look at what could go wrong, and this is actually, these are prices from a spike in volatility a couple of years back, and throwing some assumptions in there very close to November expiration. But if we had gotten a spike up to 50 or so around November expiration, the November VIX future would have stayed pretty close to that index. And just based on, and this is a move that we saw very close to, a similar move to what we saw in 2008, very close to one of the expiration dates. I like to use this as kind of my worst case scenario for a volatility spike, and this would have been the outcome based on that volatility spike. And notice, really compare the profit or loss box for the short November future versus the profit or loss for the spread. And I think that's where you get an idea of why you would go through the trouble of buying that December VIX future contract. That's what would save you from a lot more pain than you would have endured if you had just had a pure short position in the November contract. So that's just an example of a calendar spread with the futures. You've got lots of moving parts when you're thinking about putting one of those trades on. I've got an LPAN up there instead of a plan, playing into, I thought that said IPAN.
Or the LPAN.
The LPAN.
Whatever works for you.
So, you can have a directional opinion on the VIX futures. The VIX futures, I mean, again, I've cited yesterday a handful of times, but yesterday was a clear indication of if you had a short position in the November VIX future contract at $1,000 a point, that could be a pretty rough ride. If you had also had a long position in the December contract, that might have cushioned that a little bit for you. So, and there's my as I said, this study in the first half of the presentation here, where I talked about what would be the best way of going about maybe taking the other side of a VIX, a spike in the VIX. That came directly from a question from somebody that had watched one of the webinars that I'd done at the CBOE on the VIX. I welcome questions. It gives me more to talk about. If you're looking for any data on I put the CFE's website up here. Everything that I did in the presentation today, the data to create all of those charts came directly from the CBOE's website, the CFE's website. And I always try to make sure that anything that I do presentation-wise, the data is out there for other people to try to replicate or work with. And then finally, there's the education section of the CBOE's website. I'm at the Options Institute at the CBOE, and that's what that final link is there. So with that, I'm going to see if any questions popped up. I think Jim's going to try to grill me as well, maybe. So.
There are a couple of questions here. I'm trying to see if I can pull them out really quickly.
Sure.
Here's a quick question. Why don't you look at TVIX?
I will. The TVIX ETF, I will. I just.
What is the TVIX? I'm not familiar with that.
That is another one of the exchange traded notes. I think they're just about all exchange traded notes, but that's another one of the exchange traded notes that's based on the VIX.
Okay.
Really, honestly, the reason that I looked at the instruments that I looked at was because those are the ones that the person asked me about. I didn't intentionally exclude any or include any.
A couple of people asked, what does the CFE stand for? The CFE is the, Jennifer, do you want to handle this one?
It just is an acronym for the CBOE Futures Exchange.
Which is basically the arm that does the VIX products.
The futures part of the VIX, right?
The futures part of the VIX.
The options on the VIX are traded on the CBOE.
And for those of you that weren't with us for the part one of this educational series, Jennifer and Jay Cowie, who is also with Jennifer at the CFE, went into quite some detail about the explosive growth in their products that they've had. And it's a great success story for the CBOE and the CFE, especially in times like this. I know everybody knows of the VIX, but if you go back and look at the numbers or go to their website, this product really has taken off, which for not just for an indicator, but also for a trading opportunity. People that are in our arena are looking for opportunities, and obviously with these tremendous swings on this news-driven market, seems to be right now, the VIX is a very effective way. You have to, with Russell's presentation, you have to be nimble and you have to be very aware of the huge spikes and pardon the pun, volatility in the VIX. But that's also where the opportunity lies for futures traders and the options traders, and we're going to get in much more detail about the options trading on the VIX in our final and part 3 of this 3-part series. But I hope this has been educational. It certainly has for me. It just brings up a couple of different, for me, opportunities to where, if you just use a methodology like Russell's gone over, you do the 5-day out after the spike, or I think the time, the time spreads are very interesting to look at, and how the inversion, where the spike could, where the opportunities and the limitations lie. But I want to thank Russell and Jennifer again for coming in today, and I want to thank, most importantly, you people for joining us. Please contact me at OptionCity, or Jennifer at the CFE, or Russell at the CBOE CFE. We welcome any questions you have, and we love the opportunity to talk to you further about trading these products, and especially using the OptionCity platform to trade these. With that, I'm going to say thanks for joining us, and we will see you again soon. Thanks for joining in, guys.